Welcome to another Market Insight, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me this week, or this month, is Chris. Chris, we're getting closer to warm weather, which means I get to bring back the seersucker. I'm sure you're excited about me bringing that back. So why don't we just jump right into the call?
Pretty simple agenda, really. We're going to go through a few things that happened since our last call, what moved markets, and then lay out what we have for March. Because there's a handful of risk events throughout March that are going to certainly be moving the markets. So we start with rates, as always. They're our discount rate. We used the 10-year Treasury. And we talked about this last time too, but the year started at about 3.8%, came down to 3.4%. That's bond prices appreciating. And then we had the sell-off in bonds with rates coming back up. And we had said that the market handled that sell-off pretty well. And then I circled on this chart around the time when the stock market stopped liking this, when the rates had continued to keep climbing, and it really matched up with producer prices.
It's around the time we had our last call, right?
Right after then, the market had absorbed it fine. It was pretty choppy, but flat market. And then February was down only a few percent. Nothing crazy, but we did get declines after a high producer price index came in and really shifted that narrative to margins are going to be coming down and be worried about inflation again. Again, nothing crazy, but just a small decrease.
So the market is certainly trying to understand where these rates are going to go, where they are going to go long term. We're going to talk about that today, but why don't we talk about just some other components that we mentioned previously. Mm-hmm. We talked about Fibonacci.
We've made fun of Fibonacci in the past too, but
right.
It's just a retracement line. So you go from the low of the period right before 2023 and then the high, which happened in early February, and you see retracements of 61.8% happen frequently. Right. That's why these are Fibonacci retracements. And we bounced right off that number, pretty close to it, and these held. So from a technician, you would say, looks okay in the short run. By holding, I'm looking at the last three candles on the far right that said, well, the market did not break below this. Another way of looking at this that's more widely followed than Fibonacci is moving averages. Right. So it's the same chart, except the moving averages that we've used in the past are on here, the 50-day and the 200-day. And we did see a break below the 50-day. That's very common. That's stocks falling below that 50-day. But the 200-day did hold, and stocks recovered. And what this really says is the 200-day is the red line on the chart. It's more of a longer term, 200 days of average prices. We see it was declining to flattening out. So we have still a long-term downtrend to sideways, but we still are in a short-term uptrend. That's the 50-day that is coming up. So it's a short-term uptrend, still in this longer-term sideways to downward market.
So what were some of the fundamental reasons behind the move? So is it just a technical component that it's bouncing off, or was something really happening in the world?
No, there wasn't a whole lot of news. I mean, it's been slow since earnings have slowed down. But we had all the Fed speakers were coming out. Mm-hmm. And Fed Bostic spoke, and it lined up pretty closely with the timing of that recovery that we saw, the over 1% recovery last Thursday. And he had said, I only want to see a quarter point move going forward. So he took out the market's been afraid of 50 basis points increases going forward because of that hot CPI number we talked about last time. He said, no, I only want to see 25 basis points. The market really liked hearing that. He wanted to be more measured. And he said in 2024, he wanted to see rates around 5 to 5.25. Not much higher from where we are here, but that is a longer time period. That higher for longer narrative is still there.
There's a couple things I would take from there. One is that technicals are not just voodoo magic, some lines on there. What they're doing is they're trying to process all of the information or known information to figure out where the decision points are. So if the Fed would have came out and they would have been 50 or 75 basis points, it wouldn't have bounced off that 200-day moving average. It most likely would have been under that 200-day moving average. So it's just telling you kind of where the key decision points are, which we have a slide here in a minute that we can go over. But the other thing is just how the market is trying to understand its valuation because of interest rates. CPI comes in, they assume interest rates are going to go up higher, so the market sells off. Fed comes in, says yes, but the rates are not going to be nearly as high, so it rallies off of that. And it just shows you how the market is trying to process and understand these things from key points. But let's look at some...
Real quick, though, the interesting thing I wanted to say is that he acknowledged that he doesn't want to see an overshoot. So that's what he wants to be measured. Keep raising rates. Don't pause yet, but he doesn't want to see this overshoot where they absolutely kill the economy.
And what he means by overshoot is it takes some time for a lot of the Fed policy to actually impact the economy. And we've gone a long way in a short amount of time from very low interest rates to interest rates we haven't seen probably in 15 years. Instead of continuing to raise and seeing what effect that's going to have, is why don't we take a pause here for a moment and see how much this has impacted inflation so far, because there's a lag, as well as employment. But as I was mentioning, there's some decision points that the market was already pricing in, but we still have some more, and this comes from a Bloomberg article that you pulled. You want to talk about this
Yeah,
slide?
so it's pulling implied volatility around the risk events. So the 4 risk events with the red above it is Powell testimony, payroll, CPI, and then the FOMC meeting. And it's just saying, and we don't have to actually calculate these and know what's behind it, but it's just important to see that the market is aware that there are 4 big events in March that are likely to increase volatility in the market. And really, it starts with Powell's testimony. So today, on Tuesday, he's in front of the Senate, and tomorrow he'll be in front of the House answering. He does this twice a year, semi-annual meeting, and he takes questions. He has his prepared remarks where those get released right before, and pretty common. We know what he says in his prepared remarks. And then when he takes questions, totally different game. Really don't know what he's going to say. And he frequently talks up markets, but you never know. There is that risk event that he will try to talk down markets.
And I want to remind everyone that we kind of go into this cone of silence. We're not taking in new information as this testimony. We're probably getting the results right now as you guys are watching this. So know that it may be different than what we expected out of this.
And anything he'll say, he'll have, if the market doesn't respond the way he does, financial conditions don't, he'll have the ability to walk it back 2 weeks later at the FOMC meeting.
Yeah, and oftentimes it feels like he is a little bipolar, kind of going different ways. I think this is his version of Greenspan speak, where he would talk in very esoteric terms, very jargony. I know those terms are jargony in themselves, but to use another one, there would be a lot of heuristics then on what he is trying to say and the market's trying to do. I think what he's trying to do is just try to confuse the market so it's not so much playing off of what Fed policy is. It's trying to understand that, put in some uncertainty, so you're actually looking at the fundamentals of the economy more so than whatever the Fed said they would do. So I think that it's intentional to be a little bit of confusing, where he says one thing in the testimony but then walks that back during questions.
That makes a lot of sense. The next risk event is payrolls. And a leading indicator to see where payrolls are going is initial jobless claims. So this is a chart from Bloomberg showing that initial jobless claims last week actually have come down. So that's the orange red line. That's showing the week over week number. And then it's a very noisy number. So you do want to put some sort of average on it. The 4-week average is slightly increasing. But overall, nothing crazy here. We've seen jobs come down, or initial claims come down, which is when jobs have been increasing. So I think we're going to see another payroll increase. We have the next slide that shows expectations for where the actual payroll number's coming. So the far right is shaded because that hasn't happened yet. That's that March 10th risk event of, well, the market's expecting about 200,000 new jobs added. The month before was 500,000, much higher above trend. There's seasonality issues in there that I don't think, some people believe that number, I don't think we do. We think that's overstated. But looking at the data, the market is expecting another increase. And I think we're not ready, we're not past this yet while we're still in the Fed tightening cycle, where good jobs, if we beat this 200,000 expectation, will be seen as a negative, will be seen as inflationary. So we're not there yet. We really want to be seeing something around this 200,000 or a little bit below.
Right, and remember the Fed looks at essentially 2 items, which is inflation and employment. And we could argue all day on whether the numbers are real numbers or not. I don't think it really matters. They're always doing seasonality and trying to adjust so that they're comparing apples to apples, which then the comparison always misses. But what I think is I can say with confidence is we don't have large unemployment lines, and we see far more help wanted signs than we do unemployment situations. So as of right now, I would say that the Fed should be constructive on unemployment, that it's there, meaning that it's okay to pause here a little bit, or maybe even have a little bit of an interest rate hike, those 25 basis points. So we're still trying to watch the Fed and the data that the Fed is watching.
Yeah, and they're admitting that even before the FOMC meeting. They're looking at these numbers to help change what they're going to be saying in their forecast.
Right.
It's going to be a forecast meeting. We're going to see all of what their expectations are. And as Waller said last week, he's waiting to decide based on the payroll and the inflation number.
Well, I know I play an economist here on the YouTube channel, but we actually do have a real economist that we do work with, and he's assuming that we'll continue to see elevated inflation. Year over year, the consensus is about 6.25%. We've talked about many times that we think inflation will stay elevated, and what the Fed is wanting to do is see that inflation rate go below their interest rate. And I think that's the way that they want to see it, is the inflation drops below their interest rate, not they have to keep raising the interest rates to get it above. But what we're seeing here is what's driving a lot of that is no longer used cars and durables, but it's now that energy and food, which I'm sure every one of our listeners have realized that the grocery bill, the energy bill has certainly climbed, and it looks like it'll continue to do so and have that effect on CPI. So those are the two things that the Fed is looking at whenever they're trying to make these big macro decisions. And then what is driving the inflation? I see a lot of mystery and things in the headlines trying to explain it. We increased the money supply dramatically in 2020 to deal with the pandemic, and it just takes time for that to go through. So we first saw it in things like used car prices and others, and didn't see it so much in service. Definitely saw it in stocks. We're now seeing it in energy and food, and at some point it will make its way through the economy and it'll settle. I just don't think we're going to see that sub 2% inflation over the next couple of decades. I think we're going to be around between 3 and 6%, so we can just say 4.5% is what I would expect at back of the napkin numbers.
And what we're moving to is the biggest risk event of all building up to this is the FOMC meeting on the 22nd. And what I pulled on this slide is the summary of economic projections. They poll their expectations for GDP, inflation, both CPI and PCE, and the dot plots that we always talk about. The expectations of where are they going to be taking rates, where they think they're going to be taking rates at least. We'll get a new one of those, and that's really the market's going to be looking at closely, because the market really wants to see when this increase in rates is done.
Right, and I would expect that with all this talk about pause and what the Fed has said is that we'll see a more dovish plot than a hawkish plot. And I think the market's going to like that. There's a lot of uncertainty. There are continual concerns about a recession. I know that we share those on a fundamental standpoint, even though the technicals are saying otherwise. But if this comes in more dovish, the market's probably going to rally 5, 6, maybe 7% over a couple of days' time. So I think that's one of the reasons that you certainly have to be invested and staying invested here, because it's likely, I think it's more likely than not that the Fed will at least pause, if not start to slow down.
What I think it's going to show is they're not going to be going as high, but they're going to have the 2024 numbers be high too.
Right.
So they're not going to show, hey, we're going to start cutting rates in 2024. So you're going to see those expectations come out there. And the market's getting close to that. So we have the expectations here. The midpoint of 5.25 to 5.5 by the end of the year is the most likely scenario. That's 3 rate increases from here. I think the market's expecting it, right? So like you said, if that's right where they come in, good things for the market. They come in a little bit lower, as long as they're not saying, hey, we want rates to go up to 6%. The market only has a 1% probability on that. That'd be a big repricing.
Right. My guess is that this pricing, these market rates, which are a better predictor than what I believe, because it's taking everyone's information in, but I expect to see the mean, or that big percentage, to start drifting closer to that 5% over the year. But it's yet to be seen. Let's see. It's one of the things we could probably stamp and check out over the next couple of months. Was that an accurate call?
And the other thing that's been said a lot is, you said inflation at 6%, and Fed rates are around 4.7 now. They're also starting to say, well, if you include the balance sheet runoff, which is happening at almost $100 billion a month that they're reducing their balance sheet by, that's actually tighter policy than what a 5% rate would imply.
Right.
And they're saying, I think Mary Daly said over this weekend that it's closer to above 6. And we've heard the same from Bullard. So they are starting to shift the narrative that policy is tight, and we're basically almost there.
Yeah, they definitely have 2 tools that they're using, and to ignore and forget about the other one, which is their balance sheet runoff, would be that wouldn't be a correct way to do monetary policy. We've talked a lot about the risks that we are coming up, but let's talk about some other things, some market phenomena, some seasonality.
Yeah, we made it through the risk events, and now I just have a handful of slides. Just kind of some interesting points we're seeing throughout the month. And when we look historically at March returns, and this is from LPL, March is one of the better months. Recently, not so much. We have the gray line showing negative over the past 5 years. There's an outlier in there from 2020 with lockdowns that is going to skew your data, but overall, seasonality is on the side of the market for March.
And then what about the bear index?
But also the bear index, which also tends to be very contrarian, right? Had a very sharp increase. This is a individual investors survey that happens weekly, and they just say, hey, where do you think the market's going to be in 6 months? And we had a very sharp move from, well, they weren't that bearish, to now 44% of the participants are getting bearish. It is contrarian, though. Right. So once you start seeing that go up, a lot of the moves has already happened.
Yeah, I love the adage that the market seeks to punish the most amount of people as possible. So if more people are bearish, it's probably a bullish market. So.
But it's not like it's not one of those peak bearish numbers, right? Where if you start seeing peak bearish at something over 60%. That's almost a buy signal of saying you have to go against the grain and buy.
And it's not just retail investors, right? There's different discretion that managers have. Both they have the discretion to make it, or they're using some type of policy or rule.
Right.
You want to talk about this slide?
Yeah, this is from CTA's, Commodity Trader Advisors, and it's just generally showing the trend. So discretionary is in green, kind of just flattening out, coming down a little bit in the short term, saying they're lightening up some of their equity positioning. Versus the quant guys, the systematic traders, they're increasing their equity allocation. It's the technical stuff we're talking about, where you have a short-term uptrend. That's a buy signal for them. So kind of in the same risk, the risk would be if the market flips and those technicals change, you're going to see some more positioning to the downside from those quant guys. So it is important that we're still checking in on these technical levels that we've been talking about.
Right, and I guess it'll be a gut check, right? Are they gut right, or was it better to buy a little bit low based on those technicals? Earnings.
Earnings. We talked about them last time. They were almost done. Now we are done with earnings. Not a whole lot has changed. The beat rate was still at 69%. That's below the long-term average of 77%. Earnings were actually negative for the quarter, and they were very negative if you get rid of energy, because energy was an upside beat, where earnings were down 9%. The part that's concerning here is the forward price to earnings ratio. It is elevated. We're at almost 18, that's 17.8, which is below the 5-year average where we have had elevated PEs, but the 10-year average is a little bit lower. So it's just something we're watching, because if we keep seeing earnings coming down at 10%, that's going to decrease. Right. The multiple will come down.
If you have a higher multiple, the market at least is pricing in that they think earnings is going to recover and recover soon, and that this is actually a lower PE than what forward earnings would expect. And well, I guess we haven't seen that yet. And then if you're comparing them to 10-year, it may be below, but look at the interest rates over that time frame. So there would be a justified PE that would be higher relative to an interest rate environment that has higher interest rates.
Right. But what we are seeing is earnings expectations are starting to come down with the market. Right? The market led the way down, and now the earnings expectations, we can just look in the top far right of this, the blended forward EPS is coming down pretty significantly, bottomed out a little bit here while the market has recovered. So I just wanted to point out that what I already said, which is if we keep seeing earnings come down, that's going to be a problem for where the market's price. We do need to see flatten out or an increase.
And we don't know where the bottom is on any of this, but this also has a little bit of a contrarian tilt as well, because people tend to be very optimistic in the bull run. They overestimate what earnings growth would be, and then it turns out that they're wrong. And then whenever we get into rough markets, they become more pessimistic than what the situation calls. So this may be signaling, whether we've seen the bottom of the market or not, but we're starting to see characteristics of a market that is bottoming. So we're probably further along through this process than what it feels like at times.
Yeah. And really to bring it towards the summary of saying we want to stay high quality. I think this shows that as well. This is showing earnings quality. So a way of measuring that is you take net income, the earnings that they're actually reporting, you add back some of the non-cash charges. That's the black line that's climbing and starting to show some disparity from the cash flow from operations. And what they're saying basically is that the quality of your earnings, you're starting to report something that probably has some accruals, some management messing around with accounting, and you're saying that the earnings quality is really starting to come away from the actual cash flow. It's in a lot of textbooks as a warning sign for where earnings are headed. It doesn't have to be, but it can be. It's just an early sign of saying, make sure we're in high quality companies, which we are, which means if there's a very strong market rally, you're not going to participate in an extreme rally, because that's going to be a lot of low quality companies, but we want to stay high quality.
Right, because as you said, this is probably just accounting engineering. You have certain profit margins, certain earnings that you want to hit, and this isn't cash generated. This is some accounting maneuver to offset or bring, but you can only do that for so long. So there's just some short-termness in that. But to your point, stay high quality on this.
This was just another slide from Goldman that I thought would show kind of the market getting a little ahead of itself. The long-term historic average on purchasing calls before earnings is much lower, around 10%. Where you buy calls before earnings, you sell them after. We had much higher, 29%, at least partially through the quarter when this was taken, of that strategy working. That was saying the market was probably underpricing volatility and getting a little too optimistic.
Right. So just as you said, it's just a way to measure the optimism versus the actual earnings, and people are saying are probably underplaying the risk that is there in the earnings. Any other comments?
No, I hit everything.
All right. Well, Dan did not fix the lights, so go ahead and hit that like button if you want me to do the seersucker. But send him an email so we get these lights back on. And while you're down there hitting that like button, hit that subscribe button if you haven't done so, or hit that share button because we need more people to watch this so we can get these lights back on. Dan, please get our lights fixed. Thank you. We always enjoy this time with you, and we look forward to seeing you next month.